Hello, my name is Betsy Reiteman, and today I'll be walking you through a thorough analysis of my enterprise valuation of Procter & Gamble. Procter & Gamble is one of America's largest consumer packaging groups. They own brands such as Pampers, Tide, and Gillette, so chances are you probably used a Procter & Gamble product today at some point. 6 years ago, they started a restructuring plan and they hired what ended up being two new CEOs. And the current CEO was hired about 2 to 3 years ago, and he's really focused more on long term growth versus quarterly results. However, within the last few years, they've yet to see that long term growth really come to fruition. So shareholders are continuing to get more and more frustrated with that CEO, which ended up with the newest board member, Peltz, who is really pushing the company towards new acquisitions and telling them to kind of ditch their old brands that nobody wants anymore and really go in a new direction. And so I think that kind of is where this valuation will kind of stem from and really starts the conversation there. For my analysis, I used the SEC filings to construct a balance sheet and an income statement. I did use the template for Better Buys as a starting point because I really did think that was really helpful as I was learning and doing that example to help calculate the free cash flow and then to use the pro forma statement, analysis. Obviously, real life is a lot more difficult than the easy, perfect book examples. For example, their income statement didn't incorporate depreciation into net operating income, which we were taught to do following your example. They also had a lot more rows just related to mergers and addendums and things that were kind of outside the scope of what we covered this semester. So I did my best to kind of match up the rows that I recognized and that I knew where they should belong. But again, I kind of knew that wasn't a perfect example like Better Buy, so my numbers weren't necessarily going to match what they were getting for their analysis with the SEC filings. I included my full tables in the appendix, as well as the Word document that goes along with this that has all my citations for both the paper and for here. I did use the historic data to calculate the firm's free cash flow and the equity free cash flow. Again, because of the complicated balance statement and income statements, they don't match perfectly like you would expect and like we were taught to do in class. But I tried to get them as close as possible. And really, for me, it was more about the process of learning how to, what numbers should go in where and how to actually get to those numbers. So after looking historically, I did make some assumptions about the future of the company for the pro forma statement. For assumptions, I based them on revenue growth rate and percentage of sales. Revenue growth as a static number is not ideal, especially in the CPG industry, but it is the easiest to use, and it is what we learned this semester. Using it, however, is one of the biggest risks that Procter & Gamble's evaluation faces. To factor in these risks, it's important to look at market and demand. And really looking at the CPG market, it's a really tough industry to be in right now because customers' preferences are constantly changing. Where we used to just care about, well, this is the lowest price laundry detergent, so I'm just going to get Tide. I know that brand. Now, all of a sudden, you have people that are focused more on company missions and more scent availabilities. And, I want something that's allergy-free or something that, is produced at fair wages for the company. And really, people are taking a lot more into account with how they're spending their dollars, even on things as minuscule as laundry detergent. Additionally, there's whole new purchasing channels that customers are using, such as e-commerce. E-commerce is kind of trickled down. It used to just, be apparel and technology. And now people are buying laundry detergent on Amazon, and people don't even go to Walmart to get that anymore. And suddenly, where Tide used to have best placement and they used to have all these negotiations with the Walmarts and the Targets and things like that to really get their product on those end caps. Now all of a sudden they're starting over with these brands such as Amazon and things like that, where they are in a whole new industry and a whole new channel to get their products to their customers. So their big brand advantage really doesn't play as strong of a role as it used to, and it doesn't give them as much of an advantage. Additionally, the barriers to entry are a lot lower for these brands now because we used to have a certain amount of product to get on shelf at Walmart. Now, you could be on Amazon with very little inventory and really just kind of make it on demand, and they're suddenly competing against a lot smaller fish in a way bigger sea. But it's giving the customers a lot more choice and really hurting these big companies. Additionally, to mitigate the risk in my analysis, I performed a Monte Carlo analysis on the revenue growth rate. So I used 3 different numbers and created 3 separate pro forma analysis to see how the revenue growth rate would impact the enterprise valuation. So I looked at an increase of 5%, a decrease of 0.4%, which is the historic growth rate between 2016 and 2017. And then I used a decrease of 5%, which is the average of 2015 to 2016 and 2016 to 2017. So what I actually found was the highest enterprise valuation was with the largest decrease in sales, which seems funny. And so when I went back and looked at the numbers, I found that it was actually because the investments were calculated at a percentage of sales. And so when you had a higher number of sales, your investment costs were a lot more expensive. And so the sales just weren't growing at as much as they needed to be to cover that higher investment cost. So really, that's something that Procter & Gamble would have to just completely overhaul as part of their financial planning and things like that. So taking that into account, and looking at the competitive market, I chose the historic rate between 2016 and 2017, which was 0.4%. And that does seem harsh to think that I'm not even forecasting growth within the company. I'm seeing it decrease for the next 5 years of the planning period. However, I do just think it's realistic based on what I just finished talking about of the changing consumer needs and just the changes to the way that people are purchasing things. I just really don't see Procter & Gamble recovering and going into positive sales growth in the next 5 years. Using the sales decrease of 0.4%, I established an enterprise valuation of $31,435 million using, again, the pro forma and free cash flow analysis. I then compared it to 3 competitors, Colgate, Unilever, and Church & Dwight. And using their Yahoo Finance figures, I calculated their EBI-TDA multiple. And the average of those 3 competitors was about 15, while the number that I found for Procter & Gamble was 3.7. So you might be like, well, you really messed up. But those numbers were for the last quarter, where my numbers were for 2017, 10K. Additionally, those were based on Yahoo Finance figures, which are pretty accurate. Mine was with some arguable human error in my calculation. However, I do still feel that Procter & Gamble's number would be lower no matter what. A low EBITDA multiple is an indicator of high risk and low growth opportunities, which I've continued to find in all my research about the company. So I do think that low number is indicative of the direction that I see Procter & Gamble going. It's also important to look at their borrowing strategy. So they're currently in the midst, they just announced that they're buying back $1.25 billion in debt at 8%. And they're going to be refinancing that debt at a current lower rate. So that'll present some cost savings. And then they're going to hopefully use this cost savings to finance new acquisitions, which is something that Peltz is really pushing for. Their newest purchase, they just announced that they were going to pay $4.2 billion for a consumer health brand from Germany, Merck. And so obviously they're going to have to take on more debt to finance these acquisitions. They're also in the process of selling some of their underperforming brands or kind of unrelated business units. They just sold off some hair dye and some makeup brands and things like that. So they're really trying to streamline what they focus on. Overall, I really enjoyed applying a semester's worth of learning to this project. Again, it was much harder than the book examples, but it's really cool to actually apply what you're learning and to see how it plays out in real life. I also really came to appreciate group work because you have checks and balances along the way. Doing it by myself, I would get so far and be like, well, I think this is right. And it was hard not having somebody to check in on. So I really came to appreciate my group projects from my other classes where I used to complain about them. It also would be really interesting to do this project where everybody took a different consumers are right or where they're going in the future.